Vici Properties Stock, ticker symbol VICI. Is this the best REIT to buy right now? Vici is up 6.7% year to date, which is quite similar to the overall market. The S&P 500 is up also 6.7% year to date. On the 27th of October, Vici presented quarter results where they beat on both FFO and revenue. On the 23rd of February, they will present new quarterly results where 7 analysts expect a beat, and only 1 analysis expect a miss. The reason why people love Vici is because of the dividends. Dividend yield is sitting at 4.6%, which is of course an insane number. But does this mean that Vici stock is a buy at current prices, or is it a dividend trap? Well, in this video I'm going to show you real quickly what Vici does, the most recent earnings, the fundamental analysis, dividends, and in the last part I'm giving you my price target to see if they are a buy or not. And I think you definitely want to see that part, so make sure to watch until the end. And I'm also very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does Vici do? Vici Properties Incorporation is an experiential real estate investment trust that owns one of the largest portfolios of market-leading gaming, hospitality and entertainment destinations, including Caesars Palace Las Vegas, MGM Grand and Venetian Resort Las Vegas, 3 of the most iconic entertainment facilities on the Las Vegas Strip. When we check the most recent earnings of October, we see that the revenue increased quite a bit, 100%, and this is also lockdown related, so that's something to keep in mind. Next to that, total revenues was primarily related to incremental revenue from the acquisition of MGM Growth Properties. FFO and AFFO have increased quite a bit as well, which is very important to me, since this is one of the more important numbers with REITs. They announced a $203 million acquisition of Rocky Gap and also a dividend of $0.39 per share. With AFFO sitting at $0.49, dividends are very well covered, so that comforts me a lot. Dividends were increased by roughly 8% year over year, so that's also very nice. For the upcoming earnings this Wednesday the 23rd of February, they expect to report an AFFO of $1.91 to $1.92. If we check their portfolio highlights, we see that Vici has 49 leading game facilities, of which totaled 124 million square feet. This includes real estate and golf courses. They have more than 450 restaurants, bars, clubs and sportbooks, almost 60,000 hotel rooms and 4 championship golf courses. If we check the tenant breakdown in the investor presentation of November, we see that Caesars is the biggest tenant with 18 properties and 43% share in annual cash rent. MGM was the second largest tenant with 13 properties and 33% cash rent share. From there it drops significantly in amount of properties and cash rent. They have a lot of tenants, but the 2 biggest tenants make up more than 75% of the annual cash rent, which is not really diversified if you ask me. 45% of the rent roll comes from the Las Vegas, and 55% is coming from regional assets. And now that we know more about the company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. Vici is a 33 billion market cap company with a PE ratio of 41. But since this is a REIT, I don't want to focus on the PE ratio but use the price to FFO. Price to FFO is at 31.5, which is too high in my opinion. I prefer 16 or lower. This could indicate that Vici is overvalued right now. Later in this video I will show you my 3 price targets for Vici, so make sure to watch until the end, since price to FFO is only telling a small part of the full story here. Revenue is at 795 million, and in this graph we see that revenue is going up really nice and steady, which is something that I really like of course. During the lockdown periods revenue was flat, which is of course quite logical. After things cooled down, revenue went up again. Over a longer period of time we see that margins are going up and down quite a bit. Most recently margins are down, so that's something to keep your eye on. And it's the same story with the EPS, so that's also something to keep your eye on. Analysis expect EPS to increase quite a bit in the coming periods, which is very interesting. But in 2024 it's expected to return to normal levels, which are low single digits. And it's the same story with the revenue growth in the coming years. Return on assets is sitting at 2.2%, which is the average for a REIT, and it's the same story with the return on equity. Return on invested capital, the most important number here, is at 2.1%, which is kinda low, even for a REIT. I really like it when the current ROIC is higher than the 5-year average, but unfortunately this isn't the case here, so that's something I don't like. The balance sheet is something that I don't like as well. Current ratio is at almost 58, which is way too high. You want this number below 2 for this type of company. Another thing to keep your eye on is the total debt and total cash. I prefer companies who can pay down at least a third of the total debt with the total cash. Right now total cash is at 580 million, while debt is at 14.5 billion. So it's very important that free cash flow is growing, since this is used to pay down debt, do acquisitions, buy back shares and all other things. In here we see that free cash flow has grown quite a lot in the past couple of years, and is also quite steady and consistent. However, most recently it didn't grow that much. If we check the shares outstanding, we see that it's going up quite a lot in the past couple of years. Usually this is not a good sign, but REITs issue new shares to raise capital and grow the business, so I'm not worried that much about this number. Next up are the dividends. Dividend yield is sitting at 4.6%, which is a really good number of course. Annual payout is at $1.56, and earlier in this video we saw the payout ratio is around 75% and not the 137% displayed here. That's because REITs use AFFO to pay out the dividends. The 5-year average growth rate of the dividend isn't displayed here as well, since they only pay dividends for 4 years in a row. Overall, a great looking dividend scorecard, but how about the historical returns? I decided to compare Vici stock with the overall market, in this case the S&P 500. Next to that I added gaming and leisure properties, one of the competitors of Vici. We're looking at returns including dividends. On the 5-year chart we see that Vici had the highest return with 147% versus the S&P 500 returning 64%. GLPI had a 180% return, so both stocks did beat the S&P 500 on the 5-year chart. On the 1-year chart we see that Vici has beaten the S&P 500 again, with 27% versus minus 5% for the S&P 500. GLPI did also great with 26% return. On the 6-month chart we see that both Vici and the S&P 500 were beaten by GLPI. Vici and the S&P 500 also had a negative return. On the 1-month chart we see that the S&P 500 has beaten both Vici and GLPI. So bottom line, Vici did beat the S&P 500 in the long run. But does this mean that Vici stock is still a buy at current prices? Well, let's check the 3 price targets that I created using the Everythingmoney software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 8% because of what we saw in the earnings report and also because of the analysis estimations. For the mid assumption I'm filling in 10%, and for the high assumption I'm filling in 12%. For the profit margin I'm filling in 35, 38 and 41%. For the free cash flow margin I'm filling in 47, 50 and 53%. For the PE ratio I'm filling in 20, since this isn't a fair metric to use for REITs, but we have to fill it in. And the price to free cash flow I'm filling in 18, 19 and 20, because I think there is some growth but not at a high pace, if you look at the numbers. My desired annual return is 12.5%, since I can get an easy 10% average annual return with owning an ETF. Right now Vici stock is at $33.9. I hit analyze and we see only one green number. I'm only focusing on the discounted cash flow value and not on the earnings value, since this isn't a fair way to value a REIT. We have a low price target of $21, which is a big drop from where they are right now. A mid price target of $27 and we have a high price target of $35. To me the mid price target is the most justified here, so that means that they are overvalued. My final conclusion is that I really like the niche industry they are in. However, not all fundamentals look that great, and that's very important with this company. One of the more important numbers, price to FFO, is way too high, and so is the current debt. Dividends are looking great and can bring in a decent amount of money. They also beaten the S&P 500 in the past 5 years with quite the margin. However, right now they seem overvalued to me and I'm skipping this stock. But remember to always do your own research and never fully trust on what I or other YouTubers say about the stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.